We're going to talk about trail stops. We're going to talk about day trading, swing trading, a whole host of things related to how I manage positions in both of those time frames. And I got a lot of good stuff to go over. As Dave said, my name is Tim Racette, and I have a blog over at eminimind.com. So some things that you'll learn in the next 30 minutes or so. We're going to talk a little bit about how you can set profit targets that are most likely to be hit. We'll talk a little bit about the two specific trail stop techniques that I personally use, and then we'll also touch on how you can stay in your winning trades longer, because when it comes out to maximizing P&L, it's not so much about maximizing the number of trades that you take. It's more about maximizing those winners so that you can, capitalize on the positions that you've already got on. So I recognize a lot of the names here in the room. Thanks for taking some time. We'll spend about 25 minutes working through some of this stuff. I'll keep my eye on the question box as best I can, but you can always email me later if you need. Tim at eminimind.com. A little bit about me. I've been trading since about 2006, mostly in the stock and futures markets, a little bit in the options as well. And I've been able to contribute to some places like the CME. I've done a number of the Traders Expos and had the chance to meet a handful of you guys and a handful of traders at those. They're always fun to get out. It's always, a little difficult for those who aren't in like a Chicago or in New York, where you don't have some kind of board of trade or trading hub. And I'm from the Chicagoland area, and so having access to going downtown to the board of trade, having a couple of friends who were very much going through the trading process together was super helpful. Having a couple awesome mentors who weren't necessarily downtown at the board of trade, they were trading on the computer screen, like all of us are. Having access to those types of people and people to bounce your head some ideas off of is super beneficial. So if you're in a place, in the middle of Kansas and there's nobody around you that even knows anything about trading, the next best thing is to join up with some folks who are business owners or into real estate or entrepreneurship, and just kind of work a little mastermind group just so you can, bounce your ideas off each other. Maybe you're, trading part-time in the morning and then going to a day job. And so, getting outside of the colleague realm at the office, and maybe some of these folks aren't necessarily trading, but to get your mind thinking and get the wheels turning, I've found that the mastermind groups can be super, super beneficial and very motivating at that. And who knows, maybe you come out of that with some other business opportunities as well. So outside of trading, I do like to get outside quite a bit, explore. I'm a really big into mountain biking and hiking and kind of anything outside. As I said, I'm originally from the Chicago area, but now I live in Arizona full time. And I am a former ASU Sun Devil. And for those that are on Facebook and Twitter and YouTube, you can just search eMiniMind. Tons of videos up on the on YouTube, as well as over at my blog as well. So what do you say we dive in, talk about some applicable trading tactics and techniques. So profit targets. When it comes to placing trades, you notice, the topic of the discussion here is not how to find the optimal place to enter. And that's because when you break down the numbers, you could have the best entry in the world, but if you don't have a method to manage it, if your only method is, well, I'm going to set a 2-point stop for day trading, or I'm going to set a $200 stop on a swing trade, you can let these winning trades just kind of disappear, and they can, not having a system for exiting a winning trade can almost be as bad as just not having a stop on the losing trade. So the first place to start is to look at, okay, what would it look like if I had a 3-to-1 reward to risk? So let's say you're a swing trader, you're buying, FANG stocks, and you risk, let's say you're buying an option and you're risking half of the option contract, essentially. What is 3 times that risk look like? What does, if you're using the 2-point stop on the ES, is a 6-point target reasonable? That's kind of the first place to begin. And then if we look at some tools, like if you're going to use some kind of retracement, like a fib retracement, just looking at, whether you believe in fibs or not, just using the tool to get an idea, okay, if I'm getting in the trend of this trade, I'm going with the trend, let's say, what does 20% beyond highs look like? Okay, where does 3-to-1 reward to risk put me? Where does 20% beyond highs put me? And that can, help at least show you, okay, in order to get to 3-to-1, so that I could be accounting for losses and, upwards of a 50 to 60% win rate, that would give me some padding and some margin to have some sustainable returns. What would it look like? Where would I have to place my targets? That's a starting point for those. And then the other thing that you have to realize, for those that are trading live already, it's very apparent that your results vary from if you're trading on a sim account or if you're just looking at charts. And so one thing I like to do that really helps with consistency is to have a smaller first target, especially with day trades. And I like to keep my first target at about 1-to-1 of my risk. So if I'm risking 2 points, having a 1-point target. And what ends up happening, if you go through 100 trades that you've taken, or 100 trades that you've put into an Excel spreadsheet, ideal trades or something like that, just logging all of these trades, if you take out the extreme winners, and as long as you're capping your losses at some level, what does the outcome look like? Are you still profitable? Is it 2 trades a month that are making you whole? Is it one giant winner that's, if it disappeared that month, would put you underwater? And so what I found is, in order to smooth out the day-to-day curve, the P&L curve, because arguably going all in and all out is going to give you the highest return. So if you put on 3 contracts in the ES, let's say, trailing your stop and hanging on for, all, let's say, 4 points, is going to give you a much higher return, even if you average in, the losers and things like that. But what ends up happening in reality is you don't take every trade, or maybe there's a Friday where you can't be in front of the screen and it ends up being a big winning day and you miss that one and that's not in your data set. And those kind of just real world, situations that happen mean that if your trading strategy, if you will, is giving you some bigger returns or a handful of days that are significant, we need to account for, well, what happens if I miss one of those days? What happens if I take an extra couple losers and end up with, say, a 30% worse stats at the end of the month? And so the way to smooth that out and help, bring up your winning percentage and still keep the reward to risk good is by using a smaller first target. And then I like to look at my trades in bigger groups. So, at least 20, but ideally if you can get to 50 or 100 trades, that way you're not making decisions like, oh, I'm going to put a target at 4 points based on 2 trades or 1 or 2 outliers. You need, the more data, the better. And not just that, but the more data, the more trades that span an up market, a sideways market, and a down market. If you have 6 months of uptrending, your statistics are going to look one way, and then if the market starts going sideways, well what's going to happen to your strategy if you've never worked it in a sideways market? And for those who are day trading, you know that 60-70% of days end up being range bound versus a day like today that was more trending. And with swing traders, that when we're in these trends, they might last even a couple of months, and you gotta milk that, because when the market starts going sideways and there's not as much trending, there's more gaps up one day and then a gap down the next day, and you're not seeing a lot of setups pop up, that means you're not taking any trades. And so I personally like to have a swing trading approach and a day trading approach because they complement each other really nicely. And the two most important statistics that you want to look at are the R multiple and the expectancy. R multiple is just a relationship of the reward to risk. What's my average winner look like versus my average loser? And then the expectancy is the relationship of, okay, now if I account for the frequency, my average winner and the number of winners that I have, and then my average loser and the percentage of losers that I have, what does that give me per trade? And is there enough margin or wiggle room where I can calculate those numbers out? Then I can go into my Excel spreadsheet and delete a bunch of winning trades and see, am I still positive? If I missed those 2 good winners earlier this week, what does it look like? Because inevitably there's going to be a day where something happens and you're not going to be able to trade. So I try to be here in front of the screen. Mostly I'm focused on the morning couple hours, and that's a really helpful way to stay focused and really limit your risk, because if you're sitting in front of the screen all day long, that's a lot more time that you can take trades and accumulate losers. So I personally like to focus on the morning session. And so if you do that 5 days a week, it's 20 days a month. If you miss a couple weeks out of the year, if you can time them around things like Fed meeting announcements or sometimes expiration rollover weeks can be a little funky in the futures markets. So, I try to time my 3-day weekends, the Friday before a Monday holiday, sometimes can be a little slow. So if I have to schedule something, I'll try to do it on those days. FOMC days are really good because the mornings are usually quiet until the announcement. And so the reason we look at these R multiple and expectancy is to try to get an idea of, what does the average profit look like, so that I can, build some parameters into my system. So again, R multiple is just the ratio of what is if my winner is 3 and my loser is 1.5, your R multiple is essentially 2 times your loser. And then the expectancy accounts for the frequency. So you take your average winner times your win rate, and you'd subtract your average loser times your loss rate. And so it's important to accumulate this kind of data, because that's what helps build the confidence. Because even with the best system in the world, like in the last presentation, the recording with Art, I mean, there's a lot of decent systems out there but you got to be willing to weather the storm, and you got to know what the drawdowns are like, and you got to know that, okay, after 2 stop outs on the day, I'm done. I'm not going to keep trading. After X amount down in the week, I'm going to call it. And so having those in place can really give you the confidence to then pull the trigger and get into those trades. So let's talk about 2 techniques that I use. And again, this is day trading, swing trading. I use them both. It doesn't matter what market you're trading, you can apply them easily. So the first one is an aggressive trail stop approach. I'm not using a 2-point trail from the current price. I'm actually looking at the bars or the candles of whatever time frame I'm working with. So if I'm on a 5-minute chart, I'd be looking at trailing the 5-minute candles. If I'm on a daily chart, I'd be looking at trailing the daily candles. So the first strategy is an aggressive one where I'm putting, let's say I'm long, I'm taking my stop and putting it underneath the candle's low. And if I'm short, I'm putting my stop above, just for a couple cents in the stock or 1 tick in the futures markets. I'm putting, for a short, I'm putting my stop above the candle's high. So let's say 5 minutes are going by. I'm just using the 5-minute candle to trail my stop. So let's say I get long on the pullback here on this little dragonfly doji. Every time a new candle forms and closes, then I just bring my stop up underneath the next candle's low for a long, and then bring it up underneath the next candle's low, and just continue on, because the idea is I want to be in the trade as long as the momentum is going in my favor. So if I'm on a daily bar, I'm just trading the daily. If I'm long, I'm trading the daily candles low. If it's a 2-minute bar, same thing. I'm just trading the low of each candle, whatever time frame you're working with. And like I said, this is an aggressive trail stop approach because the market is, not breaking the prior candle's low in the whole run up. If you look at this morning in the ES, even the NASDAQ and the YM, what did we do? We kind of lifted had a little rally for 20 minutes and then fell off a cliff. And when the market starts moving quickly, I would rather trail my stop super aggressively than just hit the flatten button or throw a target out there and close out of the position, when more oftentimes than not, you can get a whole bunch of more points by just trailing your stop every single candle until you get taken out because the next candle breaks the low where you have your stop. For a daily chart, I mean, you wouldn't know it because I don't have the time frame underneath per se, but or at least the bar type, time frame type. But this is a daily chart, same thing, just getting long on a pullback and then trailing each candle's low. So then the next technique is a little more conservative. And the nice thing with trading, especially stocks, where ideally you have more than one share, futures contracts, if you can get to like 3 or 4 ES contracts or 3 or 4 NASDAQ even, something where you have multiples, you can exit at multiple locations. So we were talking about setting a first target. Let's say you've got 3 ES contracts. You can have your 1.5 stop. You can have a 1.5 target for the first contract. Then your second contract, you can trail super aggressively. So if we start going straight up and we go 3 points, boom, you're just trailing your stop really tightly underneath each candle's low for a long, and then you get taken out because it's a really tight stop, but you get that quick push. And then the third technique, or the second technique that you could use on the third contract, is to trail swing highs and swing lows. So let the market pull back a little bit. Let it return to that new high and then put your stop underneath the swing low or swing high for a short. So this is what it would look like. Again, getting long on a pullback. And if you were letting the market rally, giving it a little bit of room to get away from your entry, then let it pull back and make a new high, and then you put your stop underneath the swing low. The key is it needs to make a new high, or for a short, it need to make a new low so that you can establish a swing low. And just like football players would go back, any sports athlete would focus on the basics, coming back to the structure of an uptrend, downtrend, higher highs and higher lows. What makes up an uptrend? It's this consecutive higher highs with consecutive higher lows. So, okay, then by definition, if we broke that trend, where would the trend fail? It'd be breaking a swing low, meaning changing the trend would occur when the series of higher highs and higher lows fail. And so therefore, okay, let's see. If I want to be in the trend long until it fails, then putting my stop at that failure point makes a whole lot of sense below the swing low. And so let's say you do this with your third contract for the ES. Now you've got, a quick profit target, a reasonable stop, decent reward to risk if the trade kind of shoots up quickly with with a big push like this morning in the ES. So right at the top of the hour, 30 minutes in, we sold off really hard, but then we kind of rallied a little bit and then made another leg lower. So if you're able to trade a couple of contracts and practice that, having multiple exit points, even if it's just one contract, there's so many times where I'm trading the ES and I've got one contract left and I'm just using a pretty conservative trail stop this here, trailing swings. And you catch another, sometimes you can catch a move that lasts all day if it's a really strong trend day, or you catch a big 10-point move, even with one contract. I mean, that's something. I know a lot of folks, most folks aren't trading 50 contracts or 10 lots or 20 lots on the ES. And so, 10 points per contract, that's pretty awesome. 10 points with one contract, that's still decent. So multiple exit points is something that also benefits the psychological side of your trading, because what a lot of people end up falling in the trap of is you do whatever the last trade you wish you would have done. So like if your last trade, let's say you just had a 2-point target and you closed out the whole position and it took off and it ran for 10 points. And you're like, gosh darn it, next time I'm going to trail my stop. And so the next trade, you don't have a target and you just trail your stop. And what does it do? It goes 2 1/4 and reverses on you. And so you're always on the back side of the trade. So this way, if you have that first target that's in a reasonable range, I don't like to go smaller than 1-to-1. Like if my stop is 2 points, don't have my first target less than 2 points, because that can really screw you over if you're scaling and then you put on 10 contracts and you take 5 off for 2 ticks. Now you really have to make up a lot on those other 5. So as you get into bigger contracts, like no more than a third of the position should be taken off at that first target. So that's why one of the reasons I like 3 contracts, 3, 6, 9 with ES is with 3 you can have 1 as a first target and you still have more than half the position on, but you've reduced your risk and you've gotten a little bit more smoothing in your P&L. Now, like I said, going all in, all out is typically going to give, on paper at least, the best results, but we're not trading for paper. Well, I guess we kind of are trading for money, but we're not trading for the results on paper. We're trading for actual dollars in our account. And you got to be able to have some flexibility and be able to miss a day here and there and not have it blow your whole month. So with trail stops, again, I'm looking at the chart itself. So if you're, swing trading and you're looking at daily bars, I don't concern myself with the intraday price action because I'm just basing it off of the daily bar and giving the trade some wiggle room, like setting your initial stop on a swing trade below the swing low is a great option, even below the prior swing low if you want to. But just giving it a little wiggle room at the start of the trade makes all the difference in the world. If you're trading a market like the ES, and as soon as it goes 2 ticks in your favor, you bring your stop up to break even, you're going to get taken out before the trade even has a chance to work. So you got to be able to have a statistical data set that you've tested in some form, and then, okay, say, well, I'm going to take 70% of that and say that that's more realistic. And then now I'm going to trade it live and see, what it does. I'm not a huge, personally, I'm not a huge fan of back testing and all that stuff. But if you're spending a couple of months to practice on a sim account, I would encourage you to trade multiple contracts so you can practice what it's going to be like to trade multiple contracts live. And then when you switch to a live account, start with one, but then at least you have the practice with how you're going to manage the positions as you scale. But it really doesn't make any sense to start on a live account in a testing environment with real money. Like, you got to start somewhere. You got to have some kind of hypothesis or trading idea that you want to pursue. And so a sim account is a good place to do that. So for the ES, I always use a 6-tick stop, regardless if it's a super big volatility day or a tight volatility day, because I want to either be, the trade's going to go my way, I'm going to be right, or I'm going to be right out. And when I go through and look at all the winning trades that I have, they go at the start of the trade. Sometimes a trade will chop around and it'll turn into a winner, but the ones that are good winners go at really quickly. So I could always get back in if I get stopped out. So I'd rather just cut it off and be done than kind of hang on. So the ES is a case where a lot of times a 1.5 is not going to be underneath a swing low for an entry. But if you're trading like a pullback on a 5-minute bar, let's say, market pulls back in the 5-minute bar and we're going down, down, down for 20 minutes. And then all of a sudden we break above the high of the low bar. That's a really good way to say, okay, the momentum is just like, look at it the opposite of trailing your stop. If the market is going up, 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 and I'm putting my stop underneath the low, underneath the next candle's low, and then all of a sudden we break a low, the trend changes, you could use that as an entry to get into a short. Market's going up, 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 we break a candle's low, you get in on the short. And so regardless of if you're using an aggressive trail stop or the conservative stop, it's good to have some practice in that before you kind of go into a live environment. So take advantage of the sim account, just know that it's not real, and it really, there's a lot of pitfalls with that. So the sooner you can get to a live environment, the better. When it comes to staying in trades, we kind of talked about this. Being patient at the start is really helpful, and then waiting to move your stop until you actually break a swing high. So like, leave your initial stop alone until you come up here and break above a swing high. And then a lot of times the market will start on a run. So you can have that smaller first target to kind of get you through, well, what happens if we double top? What happens if we just bounce a little bit and roll over? But giving it a little room at the start of the trade, whether it's a swing trade or a day trade, is super beneficial. So with one contract, that's where it gets a little tricky. with trail stops or with any kind of exit point, you only have one exit point. And so, in my opinion, you should only be trading one contract in like the futures market if you're trying to work on your emotional control, and then get to multiple contracts as soon as you can. Experience what it's like to trade one contract, experience how you react to winning and losing money, but don't really focus on the P&L. You're not going to get rich with one contract. And if you put it on and left it for a year and you made a bunch of money, then great. But that's not really a trading system. So I wanted to kind of tie some of this together with 10 things that are really key to looking at the markets, and both from trail stops, initial stops, and just overall trade management. So the first thing to remember is that the market can always go higher or lower. Today's a really good example of that. You know, the market sold off kind of hard, but as you look back now, it's like, wow, that initial sell-off was really tiny in the grand scheme of things. So it's good to remember that, because sometimes we can think that the trend is over, and then 2 years go by and we're still ripping. Like I said, don't tighten your stops too quickly. You got to give it enough room to work and get away from your entry so it can be on its way. And so in line with that, it's okay to give up the small winner. You know, if you've got a first target that's smaller, you can lock in a little bit of profit, and more importantly, cut your risk down on the trade. Maybe it's not a completely a free trade, but it's pretty close to scratch, and that can do a lot both psychologically and to bring up your winning percentage and smooth out your P&L. And if you're giving yourself 2 stop outs on the day, sometimes on like a range bound day, you can have a whole bunch of trades, 3 or 4 trades early that don't really get a whole bunch of momentum, and then the 5th trade really takes off. And so this way you can kind of, okay, cha-ching, small winner, and then boom, big winner. Whereas if you just did no first target, you'd be, stop out, and then maybe you call it a day and you miss out on a winner. Number 4 is maximizing the winning trades, not the number of winners. You can get in trades, and on the really good trending days, I have very few trades, because if you get in the trend early, you can just ride it out. It's the range bound days that I have more trades. So if you can focus on trailing your stop to maximize the profit on those winning trades, then you don't have to be putting on new trades, taking on more risk, and opening and closing trades, maybe even missing a trade because you closed out and then it didn't pull back to an entry or give you a setup. I'm a big proponent of trading the same way each and every time, at least when it comes to managing the trade. So if you say, okay, I'm going to trade 3 contracts, or I'm going to risk $200 for every stock trade. I'm going to exit at 2 times my risk, and then I'm going to trail my stop below swing lows, and do that every single time, because you never know what trade's going to be a big winner. And psychologically, again, that's really helpful. I'm also a big fan of analyzing the numbers so that you can understand the probabilities and give yourself confidence to place trades. If you know what the numbers look like for the last 2 years or even the last 6 months, and you've gone through an up market, a sideways market, and a down market, that gives, personally, me, a lot more confidence as I go forward, knowing that, okay, the chance of this week being an oddball, if it's 2 losers Monday and 2 losers Tuesday, all right, I'm going to call it a week. There's a good chance that things will turn around in the next week. And so having the confidence to continue down the road is all about knowing kind of somewhat of what's been in the past and what you can expect. Kind of tying into number 4, trading less is always, for me, led to more profits. Over trading is always a huge issue for newer traders because there's so much out there to trade. And then reminding myself this isn't a problem anymore, but that I don't have to make a trade today. If you've got swing trades going on and the market gaps up and doesn't give you a day trade setup, well, hey, guess what? You're capitalizing on the move anyways because you got swing trades. So pairing those together, I find really helpful. And then lastly, keeping it simple and trying to be as hands off as possible is the way. Keeping it simple. Unless you're some kind of quantitative analysis doing complex computerized algorithms, your trading strategy should be as simple as you can, as simple as you can make it. So that's what I've got as far as trail stops go. We're got a few short minutes, but my email is up here if you do have questions or if you want to, chat more about anything trading related, biking related, whatever. Tim@eminimind.com. You can reach me, and I want to thank Dave for giving me some time today to speak, and thanks to everyone for tuning in this afternoon. All this stuff, you can take it, incorporate it in your own trading, and kind of take bits and pieces. But if you've got something that resonates with you, whatever it is, a strategy or a market or a time frame, I would encourage you to go deeper and focus on that, because the more you split your focus and constantly bounce around from strategy to strategy, and oh, I'm gonna trade options and I'm gonna trade stocks, and oh, now I'm gonna go here and day trade, you really never get anywhere. So being focused, being intentional, and kind of going deeper and building yourself a niche, I found in 12 or so years of doing this, that's really been what's driven my own success. So thanks everyone for your time today, and have a great rest of your week.